Hi there, good morning. This is me working on the first mock exam for tax. So really, this is really a tool for you to use as a revision tool, really. So when I do this, I will almost somewhat be teaching as well as doing the question. So I'll be looking at a few other areas briefly. So in case areas I feel would have affected your thinking about the situation. So let's start at the beginning. Yes, task 1.1, and we're literally going through each of the individual tasks as we go on. So your very first question that's given to you is that you're told to match, if you like, these issues here, whether or not these items of expenses or income, and discuss really whether or not they are allowable or not allowable. As you know, we are interested, really important to highlight this, we're interested, if you look at the question, in trading profits. And I think that's really important that you understand that trading profits are kept separate, if you like, from the other, if you like, sort of sources of income. So an individual, because that's what we're dealing with here, an individual can have trading profits, they can have employment income, if you like, and they can have pension income, right? They can have property income, right? So it's really important not to mix this up, because trading profits on their own have the unique benefit of being able to be carried back. So you can understand that if you're able to put things into this bracket of trading profits, you may be able to carry them back. And when I say carry them back, for example, a trading loss, if you can carry trading loss back, then you can offset profits from previous years. So you can see why it's possible that if you have losses that aren't trading, people might want to put them in here. So that's why we have this whole discussion about what can go in here and what can't, right? Which is where we have this question about treatment. Okay, great. Like I said, I'm doing a mixture of teaching. And so, for example, the first issue here is general provision. So this is an expense, general provisions for irrecoverables. It's perfectly allowable for just preparing your financial accounts for reporting purposes. It's perfectly allowable for reporting purposes. But because we're talking about general provisions, we can't allow them. So really what's happened here is that you would have had, I don't know, some profits of, because we always start with profits, but it doesn't really matter. I'll start with revenue and expenditure. And you would have had some general provision in here, right, that you would have deducted, right? So imagine that your revenue had been 1,000. I'm just going to pretend this is the only thing that would have come out, and this would be 900. So your profits would be currently showing 900. What this is really saying is no, this is not allowable for taxable purposes. So you need to add that back. You need to add that back. So we go back to our original profits of, it's really, so that's really the point there, disallow. So we don't allow it, and then we add that back, all right? Donation to political parties. So you can see, like I say again, that these deductions to political parties are not allowable for taxation purposes as part of trading profits, right? This is really important in terms of trading. So trading profits are key, they're special. So we need to make sure that only events relating to trade are included in that bracket of trade. Right? That's really important. So we need to therefore, because this donation would have been a deduction, so imagine this had been 2,000 and this was 1,500, which is this. Your profits are currently showing 500, right? They're sort of saying, no, add that back, add the 1,500 back to take us back 2,000. So therefore, that donation as well is not allowable, right? Now, if you, as part of your trade, had given items to customers, they wouldn't ordinarily be allowable, but all food, full stop, is just food and drink is just not allowed. So yes, you might have had 2,000 as your profits or your, let's just say, revenue, and let's just say the only expense had been these bottles of whiskey, and you're given 45 times, I don't know, to 10 individual customers, and you deducted all of that, and you'd have had something like 1,550. What they're saying is, because they're food and wine, you cannot therefore allow this as an expense. So therefore, we will add it back, and then you will have profits of 2,000, right? So back again. So the other point there is not to allow that. Right, good. So the next point, of course, is interest received. So interest received. What we're dealing with here is that maybe you had normal revenue, um, and let's just say 2,000, and then you receive some bank interest. Some bank interest. But bank interest in itself is not part of your trade. That's really important. So maybe you added 200. So as part of reporting, for reporting purposes, it's perfectly okay. So you'd be showing, remember, under other income and profit from sort of same with this one. This thing here with profit on sale of a refrigeration unit, you might have had those other under other income, right? After you had gross profit, yes, as you can imagine, but they are not trading income. So what you can see what these two things will do, interest received and profit on sale, is they'll make our profits look bigger. So we can't allow them. So what we are saying is, well, disallow them, but deduct them because they're making your profits look really big right now. So you need to your trading profits. So you need to deduct them to reduce your trading profits. Right. So bank interest. Imagine you'd have had 2,200, for example. So they're saying disallow it by deducting it, bringing it back to 2,000. Bring it back to 2,000. And finally, excuse me, repairs to a factory door, which are repairs, normal standard repairs. They're not capital. They're not capital expenditure. You're just repairing the doors, and that is perfectly allowable. So that's the first one, right? That's that. Right. Let's move on. Now, this next thing here is to do with basis points. So this is an important part of your study. Let's start at the beginning. So the first thing you always want to do, I think I always say to students, is that you always want to look at the year end. You know that for individuals, the year runs from the 6th of April, of course, you know this, to the 5th of April. This is important. The first thing, right? But now, what you always want to do, I always suggest as a good way to learn this, so you never make a mistake, just in case you made any errors here, is always look at the year end. So, for example, what is the first year end we're talking about here? Well, the first year end we're talking about here, of course, is the 5th of April, 2020. That's the first year end, right? So, and this year end, I'll just change my pen color for the sake of arguments. This year end, of course, is the year 1920. So what we're looking, so that's the first year end. Then the next year end, of course, is the 5th of April, 21, right? So we're talking about the financial year 2021. And then the next year end is the 5th of April, 22. So we're talking about 21, 22. And then the next year end is 22, 23. We're talking about the 5th of April, 23. So what am I saying? So you do this first, right? So you now know clearly what your years are, right? This is really important. First of all, so because you can see this is 1920, so it must be the 5th of April, 2020, right? 5th of April, 2021. So the next job is to ask yourself a simple question. Well, first of all, the very first period always ends on the 5th of April, 2020. So as in 5th of April. So the very first period that we're interested here, of course, will be the 1st of February, yes, 2020 to the 5th of April, 2020. This is the very first period. Every period ends on the 5th of April. That's the very first period. So that's pretty straight, no problem. Now, your next question, because I'm writing it here, you want to work with the client. You want to work with the client. So you're saying to the client, listen, I want to work with what your year end is. So you look at the year end of the client. The year end of this client is the 30th of April, 2021. So now that you know what the client's year end is, because we want to align with the client as quickly as possible, we ask the question, does your year end, sir, madam, end in this financial year? Because we need ultimately a 12-month period, which is what we prepare accounts for. 12-month period ending in the year. And if you look at this is the 30th of April, 2021. This is the 5th of April. So we cannot find that period. We just can't find it. It doesn't end. The 30th of April supersedes the 5th of April, 2021. So we ask ourselves the question, well, we need, if you like, that year. We need the 12 months. We need 12 months. So the rules are like really saying, listen, if you had, for example, imagine this had been, let's just say it had been a nice one. Say, for example, it had been 1st of February and it had been 30th of January. For example, I'm making this up now. So 1st of February 2020 to the 30th of January 2021. Well, the 30th of January 2021 would have been in this financial year. So then you would have prepared, you would have said, oh, I found a 12-month period. Hooray. 1st of February 2020 to the 30th of Jan 2021. And you'd have had a 12-month period. Fair enough, you'd have had some overlap profits, but at least it would have fitted, right? So if you can find a 12-month, if it had been the 30th of Jan 2020, it was a 12-month, you'd have gone for that because I want to work with the client. I'm imagining, by the way, that this is the client's year end. So if you can find a 12-month period, that's perfect. Now, here's a problem. If you can't find a 12-month period, as in if it's shorter than that, say, for example, say the client had come for something like the 30th of August, I'm just making this up, 2020, so a very short period, you would be forced to take the first 12 months. So you would say, listen, I'm just going to have to take the 1st of February all the way to the 30th of January. So you'd be crouching into the next period in terms of whatever the accounts would be. You just have to work it out. Right. So what have I said? If you had a natural 12-month period, you would go with it. If you had a shorter than 12 month, you would force the first 12 months. Right. And that would have been how you'd have dealt with that. But when you have such a long period that's more than 12 months that doesn't fit into the period, you have to go for what we call a 6th of April 2020 to the 5th of April 2021. So you can see here that because this was so long, we literally had to take the 6th of April, which literally is the next date, 2020 to the 5th of April 2021. What that means is that now, of course, this 30th of April 2021 is in this year. So I'm always trying to align with the client. It's in the year, right? The 30th of April 2021 does live in this sort of, although it's very early in the financial year, it lives in this period. So what am I going to do? Well, my first job is to now this means I can now sort of align with the client, and their year end is the 30th of April 2021 and 1st of May 2020. This is what the client wants. The client wants their year end to look like this. I want to make my accounts look like the client. I mean, for the next period, of course, this is, of course, 1st of May 2021, the 30th of April 2022. So the question here is, does the 30th of April 2021, which is the client's year end, live in the financial year? The financial year here, of course, is the 6th of April 2021 to the 5th of April 2022. And it does. It lives in there, right? 2021 lives in here. So this becomes the financial year that we use. So and the other thing about these questions, which I find really interesting, is you have to really read the question carefully. It says, show the taxable profits for the second and third year. So the first year, of course, is this thing, which we're not really interested in. The second year, of course, here is the 6th, 2021. And of course, we are interested, of course, in the 6th of April, 2020 to the 5th of April, 2021. And then the next year, of course, we will be interested in this at 21-22. We'll be interested in the 1st of May 2020 to the 30th of April 2021. So this aligns very nicely with now what the client wants, right? This was the aberrant, the weird one, the second year, simply because you didn't have a 12-month period. It wasn't shorter than 12 months, and it was longer than 12 months. So we had to go for the full financial year, right? So so now let's calculate. So I mean, really, to be fair, because all of these are this is a 15-month period. So these are 12 months. These are 12 months. So whatever happens here, this is 12 over 15 times 94, 920. This is 12 over 15 times 94, 920. They're both exactly the same thing because these are 12-month periods. Sorry, these are 12 months out of the 15-month period. Really important to watch that as well. Remember, this is this is profit for 15 months. So you're doing well if you're really focused right at the beginning of the exam. You have to be, right? Okay, great. So this is also good because it helps you revise if you're thinking basis periods are a bit of a problem. But I think this is the only one that could trip you. Most of the time, students are quite happy with the first year and are aware that if there is a natural 12-month period, I want to align with the client. I repeat, if I had, for some good reason, the year end had been anything, if the year end had been anything before the 5th of April, if the year end had been the 30th of March, 2021, that would have been wonderful. I would have simply just gone from the 1st of April 2020 to the 30th of March 2021, right? So my point, I'm teaching this again, I'm explaining that if the year end had been before the 5th of April, right? It had been before the 5th of April because this is the key date, then I would be working to the year end of the client, but it isn't. So I need to sort of carry on pretending or creating a year. Right. So in terms of overlap profits, now what we see here is that there are no overlap profits in from 1920 to 2021 because it naturally carries on smoothly 6th of April all the way here. The issue, of course, is that we see that when we have 6th of April to the 5th of April, we then tax those same profits. We tax part of those profits again, as in from the 1st of May. So in this period here, we're taxing 1st of May 2020 profits all the way to the 5th of April. 1st of May 2020, all the way to the 5th of April, right? Aren't we? 21. So we're taxing these profits again. So these are the overlap profits. And this is 11 months. So 11 months of profits are being taxed here. So that's 11 over 15 times this 94, 920. And those are the profits that you are taxing again. Great stuff. That's task 1.1.